Greetings. My name is Jeremy Johnson, Head of FP&A and Investor Relations at Ceridian. I'd like to welcome everyone to the Ceridian fourth quarter 2020 earnings call. All participants are in listen-only mode, and a question and answer session will follow the formal remarks. As a reminder, this conference is being recorded. On the call today, we have Ceridian CEO David Ossip and CFO Noémie Oyland. Before I hand the call to David for some brief remarks, allow me to provide a disclaimer regarding forward-looking statements. This call may include forward-looking statements about our current and future outlook, guidance, plans, expectations and intentions, results, levels of activities, performance, goals or achievements, or any other future events or developments. These statements are based on management's reasonable assumptions and beliefs in light of information currently available to us. Listeners are cautioned not to place undue reliance on such statements. Each forward-looking statement is subject to risks and uncertainties that could cause actual results to differ materially from those set forth in such statements. We refer you to our previous filings with the SEC for information regarding the significant assumptions underlying forward-looking statements and certain risks and other factors that could affect our future performance and ability to deliver on these statements. We undertake no obligation to update or to revise any forward-looking statements made on this call, except as may be required by law. The fourth quarter stockholder letter and earnings release have been furnished with the SEC and will be available in the SEC's EDGAR database in the US and the CDAY database in Canada, as well as on the Ceridian Investor Relations website at investors.ceridian.com. With that, I'll turn the call over to David. David, you're on mute.
Thanks, Jeremy. Good evening, everyone, and thank you for joining our earnings call. I hope everyone is healthy and staying safe. Before we go to Q&A, I want to spend a few minutes on some important points from our stockholder letter. First, we had a strong quarter. We delivered fourth quarter revenue results, which were above the high end of our guidance range. Dayforce recurring revenue, excluding float revenue, grew by more than 19% despite COVID-19 headwinds remaining elevated. Also, we delivered on our adjusted EBITDA guidance while accelerating the pace of our investments in product and technology and sales and marketing. Cloud recurring gross margin increased by 210 basis points to 70.9%, and excluding float revenue expanded by 380 basis points. Second, on the sales side, we did see an impact from the second wave of COVID-19 in the form of elongated sales cycles for several large enterprise opportunities, which closed in January instead of December. While fourth quarter sales were below previous expectations, when factored together with January's closing of those transactions, sales performance was in line with last year, which was the strongest quarter in our history. Our sales pipeline is very strong, and we believe by the second half of 2021, our Dayforce recurring revenue growth rates, excluding float revenue, will return to pre-COVID-19 levels above 25%. Third, Dayforce Wallet continues to go very well, and we remain confident in the wallet strategy. We continued to see strong traction in adoption. More than 100 customers are using the wallet, and over 375 have signed up in total. Attach rates on new sales have continued to be above 80%. In addition, data from our early adopters is proving our thesis that the wallet can have a positive impact on our customers' businesses. Wallet customers are seeing a 5% increase in recruiting close rates, a 9% reduction in the time it takes to fill an open position as compared to our broader group of customers. Additionally, wallet customers experience 42% lower voluntary turnover among employees using the wallet. These metrics will continue to strengthen and validate the value proposition of the wallet, creating quantifiable value for our customers and their employees. Finally, we are very excited about the acquisition of Ascender. Ascender provides payroll for more than 1,200 customers, serving more than 1.3 million employees across APJ. Combined, we will serve over 1,500 customers and 2.5 million employees in the region. This positions us as the dominant contender in APJ, one of the fastest growing regions, and provides a significant cross-sell opportunity for Dayforce. We expect the acquisition to close in the second quarter and will provide greater clarity into the financial implications of the acquisition at that time. I would like to now hand it back to Jeremy to open the call up for questions. Thank you.
Thanks, David. As we go through the Q&A portion of this call, I'll announce your name. And at that point, we ask that you please unmute your line and ask your question and then remute your line. We also ask that you please limit your time to one question and one follow-up. First question comes from the line of Mark Murphy of JP Morgan. Mark, please go ahead. All right. Mark doesn't seem, Mark, are you on? No. We'll move on. The next question we're going to go to is Mark Marcon of Baird. Mark, you please go ahead.
Hey, everybody. Wondering if you can talk a little bit more about the impact with regards to the sales in this quarter and what spilled over into January. And should we anticipate that the first quarter sales numbers are going to end up being elevated because of what was, what fell into this quarter? How should we think about that?
Yeah, Mark, it was a handful of very large accounts that closed in early January as opposed to late December. What I'd say is that the customers were less reluctant to call executives back to just do the T's and C's. So in all cases, we're in the final stages of contracts, normally black line, just waiting for final signatures, and they spilled over into January. In terms of revenue impact, obviously it's minimal because, as you know, we typically recognize revenue on the whole when the customers go live. In terms of January, we're optimistic about the actual quarter. We had a strong January, obviously, given the spillover from December, and the pipeline still remains very strong.
Great. And can you talk a little bit about the pipeline? We're hearing some, some chatter from some systems integrators saying that there's a greater number of really large enterprises that are looking at digitizing their HCM processes to an even greater extent than they were previously. Are you seeing that? And how do you think that unfolds over the course of the year?
So it's an interesting question to ask. Remember that we've been moving up into the large enterprise space over the last 18 months. So it's hard to differentiate if there are more opportunities out there, or if it's just us being more relevant in the large enterprise space.
That being said, David, can you just say how many more opportunities you're seeing relative to what you would have expected, or anything along those lines?
Well, Mark, it's hard to really, again, differentiate. Obviously, we are seeing more opportunities. I don't know if it is, as you said, more large enterprises looking at digitizing their HR processes, or it's just that we are a proper contender. And, there are a lot of data points in there. Obviously, we had many more large deals last year. We were included in the Gartner Leadership Quadrant, which obviously makes us much more relevant for that particular enterprise space as well. Our global offering has strengthened as well year over year, and most of those large opportunities do have a global component. So we are seeing more large enterprise deals, but I can't tell you if it is from more opportunities in market or just us being included in more opportunities.
That's fair. Thank you.
The next question comes from Siddhi Panigrahi at Mizuho. Siddhi, please go ahead.
Yeah. Thanks for taking my question. Just in terms of your guidance, I know you didn't give the full guidance for Dayforce recurring revenue, 22% Q2 and second half 25%. So David, what's your assumption in terms of unemployment rate, in 2021? And in that guidance, how much of this conservatism baked into new sales versus unemployment level within your install base?
Well, about 25% of our sales is add-ons to the base. And those add-ons take two forms, either additional populations, normally from their global employees, or from buying new modules. So the majority of our growth obviously comes from the acquisition of new customers in market. In terms of the growth rate, remember, it's very consistent with what we said last quarter. We said that we would expect to see the recovery in the second half of 2021, given that we saw sales recovery starting in about Q3 of last year.
Mm-hmm. Okay. And then I wanted to follow up on the international opportunity. Last year, you talked about expanding into 20 countries, and now you mentioned about 50 countries. That seems like pretty aggressive international expansion. So what sort of revenue contribution now you have, and how should we think about the international revenue contribution going forward?
So, Siddhi, as we move up market into the enterprise space, we obviously see many more global opportunities. The acquisition that we did of Excelity last year had a very positive impact in helping us with global opportunities. So we did see a lift, if you like, in win rates, especially with organizations that had populations in APJ. Our upcoming acquisition of Ascender obviously will strengthen us in that regard as well. But we also have continued building out native capabilities into Germany. The UKI region has done tremendously well over the last year. So we remain very optimistic on the global side.
Thank you, David.
Next question comes from Samad Samana at Jefferies. Samad, please go ahead.
Hi, good evening. Thanks for taking my question. So, David, as always, we appreciate all the thoughtful remarks in the shareholder letter. That's always very helpful, especially when there's this much uncertainty. So thank you for that. But maybe in the remarks you talked about returning to pre-COVID growth levels. And so I just wanted to triangulate maybe a little bit further on that. Does that mean that you think that the growth for Dayforce recurring ex float will get back to that 30% plus type of level that we saw in 2019 and 1Q of 20 before COVID hit? I'm not trying to pin you down on the timing of when that happens. I don't think any of us know, but is that you saying that 30% is achievable as a return level?
So, Samad, I don't want to put a number out outside of guidance, but what I will say is we've given a guidance number that we feel quite comfortable with. There's still a bit of uncertainty around the impacts of COVID. For example, if I look at Q4 that we just passed, we had expected to see about a $2 million recovery in terms of employment levels. So the impact from higher employment increasing our revenue by about 2 million. In reality, we only saw about a 0.5 million recovery. And so it all depends really on what goes on with the employment levels as we move into the second half of 2021. If we see the recovery kind of solidify, then I think we can be a little bit more aggressive in looking at the growth rates in the second half of the year.
Great. And then as my follow-up, I'd like to maybe kind of add on to Siddhi's question around the international side. Clearly with the 3 acquisitions over the last couple of years, I'm curious if you could give us any data or at least anecdotal data points on how the uplift has looked for customers that were using Excelity, that have added on Dayforce products or RideTech, and just so we can start to think about what the long-term opportunity looks like. So if they were spending X dollars before. What's that revenue uplift or sales uplift look like when you've sold in your Dayforce products into their base?
So I don't think we've disclosed the uplift number on the upsells to Rytech and to Excelity, but we obviously do expect a significant cross-sell opportunity. So if I look at the Ascender opportunity and I break it down, 1,200 additional customers, most of them actually are quite nice and enterprise size. That provides a significant opportunity for us to obviously migrate to Dayforce, and Ascender effectively does payroll. So we should be able to add on workforce management and all of the various talent components as well. So we're quite excited about the opportunity over there. One other point about Ascender is when you combine Ascender with Excelity, we're at about 1,500 customers, about 2.5 million employees paid, and we believe that positions us as the dominant or leader in the APJ region, which is the fastest growing region for human capital management. So again, a very good data point, another reason for optimism.
Great. Really appreciate you taking my questions, and I'll turn it over to the next analyst. Thank you again.
Thanks. Our next question is going to come from the line of Michael Turin. Michael, please go ahead.
Hey there. Thanks, everyone. Good afternoon. Good to see everyone. Going back to just the questions on the shape of Dayforce, I think we're all just recalibrating and can appreciate the moving pieces there. Last quarter, you were guiding for what looked like a slight acceleration into Q1. It looks like Q4 actually came in a touch ahead of maybe where we were modeling, but the Q1 outlook now implies maybe a slight step down before you move back up towards that 25% target in the second half. So I know David mentioned some of the enterprise impacts, and there are some good details in the letter, but can you just help with level setting if there's anything else driving that change in trajectory, and maybe just touch on also how much visibility you have into that second half target level?
So we obviously go into the year with very good visibility. In terms of Q1, you're right, we outperformed in Q4. And if employment levels had improved to the level that we had expected, you probably would have seen another about $1 to $2 million of revenue on the Dayforce side. However, the employment levels haven't recovered to levels that we had expected when we did the Q3 call. And so we're taking that into account when we look at the Q1 guidance. Noemi and Jeremy, anything else that you would add to that?
No, I think that's a good summary. I think the other thing I would point out is on the professional services side and implementation, we've seen a pretty steady pace of go live in Q4. And I think that may have shifted some of the revenue expected from Q1 to Q4, but really beyond that, I think David covered it all.
That's helpful color. If I can squeeze in just a quick follow-up on Wallet, the numbers keep moving up. It's now 100 customers using and 375 signed up. That's a pretty big sequential step up from the 200 last quarter. Are those some of those stats that you laid out, are those at all helping with adoption and traction? It would seem that some of those metrics around things like retention and turnover in this environment could certainly help with adoption on something like Wallet.
So a few things on Wallet. The actual numbers are slightly higher. I think it's actually about 122 customers that are live on Wallet, and 399 customers have signed up. So obviously we're still seeing rapid, if you like, adoption of the actual Wallet. Obviously, yes, so as we see the economy moving to recovery, probably starting in the second half of the year, we expect that focus will be on talent acquisition, and the fact that Wallet significantly improves the time that it takes to find people, the time that it takes to actually, the probability of closing helps a lot, and also the fact that it reduces voluntary turnover across Wallet users is obviously a big selling point, but not only for Wallet, but actually for Dayforce as well.
Makes sense. Thank you.
The next question comes from the line of Dan Jester. Dan, please go ahead.
Great, thanks. Good afternoon, everyone. So sticking with Wallet, we've seen a couple of stories about state and local authorities looking to potentially put some additional regulations around earned wage access and limit some of the fees. Is that something that you're hearing, and does that have any impact on how you think about rolling out Wallet from here?
So Dan, I appreciate the question, but that's actually how we differentiate in market. We don't charge the employees any fees. So if you compare our wallet to some of the third-party wallets in market, they charge a certain amount per month per active wallet holder or card holder. We don't do that. We don't charge any direct fees for usage of the wallet. So there's no fees to load money in. There's no fees to effectively spend on the actual wallet either. And so we had expected that, and our belief is that in the longer term, this construct of a pay period, which as you know is weekly, bi-weekly, in some cases even monthly, no longer makes any sense. People should have access to their earned wages as they earn it.
Great, thank you. And then, just maybe turning to margins and sort of the comments around 2021, can you help us think about the sort of the puts and takes between sort of the step up investments and the fact that float revenue is going to be lower? Would margins excluding float, could they go higher in 2021, or do the investments offset that? Thank you.
So from a margin perspective, the metric we look at most is our gross profit on recurring revenue on cloud. As you know, that went up by 200 basis points or 380 basis points ex float in Q4. We would expect to see that metric continue to grow into 2021. In terms of EBITDA margins, it's another year that we do have headwinds. If we do look at it, if I look at just Q4 alone relative to the prior Q4, the impact of employment levels was about $9.5 million as compared to Q4 of 2019. And we had a float headwind of about $7 million compared to 2019. When we look at Q1, we go in again with headwinds from the employment side. I believe, Jeremy, correct me, or Naomi, correct me if I'm wrong, of about $6.5 million.
Mm-hmm. Yep.
And from a float perspective, I think we actually go in, at least from a Q1 perspective, of about a $9 million total float headwind. If you divide it out between Dayforce and PowerPay, it's about 6 and 3 respectively. Now, obviously, as we start to get into Q2, Q3, Q4, on a normalized basis, it becomes a little bit more even because we are operating in 2 COVID years.
Yeah, and maybe if I could add to the color on margins and some of the investments we're making, I think we're looking beyond 2021. As David mentioned earlier, there's a lot of opportunities with customers globally, as well as customers in the market. And we're definitely investing in our product capabilities to support those customers. And we're also investing in sales and marketing to go after that massive TAM that we haven't yet tackled. So I think that's really important. We're making conscious decisions to invest to fuel the growth of Dayforce Recurring in the future, because that's really where we're betting. But so I think we're also managing on the G&A side very cautiously to get scale. So I think the combination of both, you'll see some improvements towards the back of 2021 and more in 2022. But that's important to really focus on addressing the growth that we have, and then looking at the global opportunities and the expansion of the product capabilities. I think that's critical for everyone to understand.
Great. Appreciate all the color. Best of luck, everyone.
Thank you. Thank you, Dan.
Next question is going to come from Brian Bergen at Cowen. Brian, please go ahead.
All right. Thanks, guys. Good evening. Wanted to start with Ascender. David, can you talk about the strategy with this one as far as whether it was really targeted for the in-country expertise and to migrate the clients over to Dayforce versus more so the attractive technology that you'll layer into? And also, it seems like it's a larger deal than your other recent transactions. So I'm curious if this is a one-off or if this is a signal you're going to be in the market for bigger transactions.
So let me start with the why Ascender. So if I look at the Ascender 1,200 customer base or employee base, the majority actually is in Australia. In Australia, they actually have 2 products. One of the products is in education and in government, which are new verticals for us in market. They have an exceptionally strong team when it comes to domain knowledge around payroll, which will help us significantly in the ANZ space. because as you know, that one of our constraints always for growth is just having great people around who can help implement and support our products. The plan for Ascender is no different than what we've spoken about historically, that the technology stack is largely dated as compared to Dayforce. And so over a period of time, it provides a movement opportunity towards Dayforce. And as we do that, we would expect also to have the ability to upsell them on time and attendance, workforce management, talent acquisition, performance comp, engagement, and the like. So tremendous cross-sell ability. The other point about Ascender is when we combine it, as I mentioned, with Excelity, we do become the dominant player in the APJ region. And if I look at the APJ region, it's probably about 25% of the global TAM when you look at human capital management systems, and it's probably the fastest growing regions as well. So it gives us a significant, if you like, presence inside the actual region. And already we've seen impact of the Excelity acquisition in helping us win not only accounts in APJ, but other global accounts where those companies had significant headcount in the APJ region. So it fits very, very nicely. In terms of the future, we'll continue to look for opportunities in country where we can find great people, customers that provide that opportunity to move to Dayforce and to upsell, and to get the local knowledge, if you like, within inside the actual marketplace. So it's what I would say about Ascender, it's very much in line with what we communicated to the market well over a year ago.
Okay. And then a follow-up here around the Bureau. Can you comment on what the Bureau migration benefit to Dayforce was in fiscal 20, and what's left in the Bureau that you expect to be potentially convertible here in the future? At what point does it base out at?
So the numbers for 2020 were 5.8, 5.8, 5.1, and 4.1. Sorry, 4.4 across the a year. As we go into next year, obviously we're going to start to see lower numbers as we're coming to the actual end. And by the end of 2021, there effectively should be almost no Bureau revenue as it relates to payroll. Naomi or Jeremy, anything that you would add to color about what remains at the end of the year?
No, I'm not on that, David. I think you covered it all. But on Ascender, the other point I would make on the acquisition and why it's very relevant for us is on the global operating model that we are trying to build. I mean, we've been so far a North American Canadian company centered around serving customers globally. And now if you start to add Excelity, Rytech, and now Ascender, we're really building a region in APJ to serve our customers locally with a robust partners ecosystem. And we have a strong leadership that's going to come on board as well with deep knowledge of the customer. So I think that's also very critical for us in that regards, as we're building a real global company. So I just wanted to highlight that point as well. But on Bureau, I think you covered it all, David.
Thank you.
Thanks, Brian. The next question comes from the line of Mark Murphy. Mark, JPM, please go ahead.
Thank you, Jeremy. Thank you for bearing with me. Nice to see you, David. Going back to the comment about the impact from the second wave of COVID, certainly understandable. Can you help us understand maybe how many transactions in total you were looking at, or the dollar value bookings that closed in January? And I think more importantly, just is your suspicion, are you trying to convey that you are past the period where there would be those kinds of disruptions? Sounds that way based on your commentary. But just with vaccines rolling out and kind of the infections trending a little lower, do you think that might have been a bit of a one-off?
So, Mark, I would say at the end of last year, we started to see fatigue, if you like, in the customer teams. What I mean by that is that we didn't have the same urgency that we typically have at end of year, where it's all hands on deck from the customer to get the contract signed. So even though we were at black lines with the actual customers, getting that final signature was a little bit more effort than we've seen beforehand. So shortly after the New Year's, those transactions closed. We're talking about a handful of customers, 3 or 4 large transactions that moved over into the January. In terms of COVID, we didn't see the recovery that we had expected in Q4. And as I mentioned, we had thought that the headwinds in terms of employment numbers would improve between $1 to $2 million in Q4. In reality, we only saw about $500,000 of recovery. And so we are still seeing impact of COVID, if you like, in Q1 in terms of employment counts. We do believe, though, by the second half of the year, we should be through that. In the US already, I would say it looks like, and we've seen the numbers being published, that the employment numbers in the US seem to be going up. Canada, though, is a little bit behind because I think, the vaccine rollout in Canada hasn't been as successful as it is in the US.
Okay. If I can sneak in a quick follow-up, I think that the growth in the Dayforce revenue per customer that you've listed here, 8.5% during 2020, it's quite impressive. That has to be well above your peer group. Is it possible to just unpack that in terms of how much is larger customers you brought on that are lifting that average up versus how much of that is the existing base kind of absorbing more of your technologies?
So it's look, if I look at the ratios at the end of the year, it still was about 53% in kind of the major markets and about 35% in the enterprise side. What we are seeing, though, is tremendous upsell across our customer base. Now, if I go back a year ago when we spoke about add-ons, we typically were speaking about additional modules that we were adding to the customer. Now we're also seeing the impact of global. So last year, the add-ons were about 20%. If I look at Q4, we were at 25%. And I would say that probably is the impact of the global employee populations that we're actually adding onto Dayforce. The other point that I've mentioned that if I look at the actual growth in terms of employment counts, we obviously are up about 9%, I believe, in terms of the average size in Q4. But remember, that is after taking into account the employment headwinds that we typically wouldn't have had and the float headwinds. So if you actually corrected from that, I think it actually would have been even more significant. Other metrics that I really do think are impressive, that even in a COVID year, our retention rate remained around 96% on cloud. And if I look at our net retention rate, we remained at about 106%. And I think those are very, very strong numbers.
Excellent. Thank you very much.
Next question comes from the line of Arvind Ramnani from Piper Sandler. Arvind, please go ahead.
Hi, thanks for taking my question. I wanted to really kind of go back to digital wallet. You provided some good color on it, and also, a lot of my research has suggested that reception for on-demand pay continues to grow, and you'll really have a compelling solution. Can you talk about some of your customer conversations in terms of, are customers kind of looking at your digital wallet as a reason to choose Ceridian versus the competitor? How much is it helping on the win rates? And even if the metrics are not high in terms of actual usage, is this kind of like a secular driver where we are at the early stages, and the next 2-3 years will become fairly mainstream?
So it definitely is having an impact on our win rate on Dayforce. As I mentioned, we've seen about an 80% attachment rate of wallet to new customers. The metrics that we now also have, if I look at, remember, when we build a module, we've used the same methodology from the very onset, which is what are the KPIs we can impact at the customer through use of the actual, through the use of the actual module, and how does an improvement in that KPI translate into dollar or money benefit for the customer? And so when I look at the actual wallet metrics that we're now able to look at, and we get that by looking at wallet users versus the general population of our customers, and we obviously have almost 5,000 customers now So we have a big group that we do the test in. We're seeing the benefit on the talent acquisition side and on the retention side. And just the retention side alone, I mean, if you actually run through the numbers, you get a 42% reduction in voluntary turnover. And if you just make the math easy, you say, okay, a person makes $50,000, we're looking at typically a 10% voluntary attrition rate at a company. If they have 1,000 employees, that means that they typically would lose about 100 people per year. If we can impact that by reducing that by 40%, that means that we can save them 40 people. The cost of replacing each of those people is probably 25% of their salary. So $12,500 per person times 40 people, right? And that's obviously a big number. That's about 100K just from the use of the wallet in that particular customer. So you're beginning to see the ROI. And again, it ties back to that whole premise. We have to create quantifiable value for our customers. Now with Wallet, we extend that onto the employee side as well, because when an employee actually begins to use the wallet, they get access to their funds continually. So if you have a credit card bill that comes due in the middle of the month between pay periods, this allows you to pay off your credit card as opposed to doing the minimum payment, paying the interest at 22% on the full balance. And also, if you are someone who is really a non-banked employee or you paycheck to paycheck, it allows you to avoid those very expensive fees of going to payday loan or to actually other types of expensive types of borrowing. And when we look at the way that we've built the wallet, it leverages that continuous pay engine that we have with inside Dayforce. Remember, as we compare to any other competitor in market, with us, we have one system with one rule engine so that continually throughout the pay period, we calculate your net earnings. The wallet allows the employee to see how much they've made, net of all the deductions and taxes, add it to the Dayforce wallet, go off and spend it. We don't charge the customer anything for the use of the wallet. We don't have them change the way that they fund their payrolls. They still fund at the end of the actual payroll cycle. We don't charge the employee any direct fees or the usage of the actual wallet to load money onto the actual wallet or to actually do the spend. So again, we're creating tremendous value for the employees of our customers as well as for the customer base. And that is a big differentiation relative to anyone else in market.
Yeah, absolutely. That's an incredible success, and I appreciate providing those detailed metrics. Given the high ROI, philosophically, will Wallet always be essentially a free product, or at some point, when there's broad enough usage, there may be some fees, or are you just going to look at like changing overall pay fees?
I think fundamentally we would have just a kind of, let's call it an ESG, a challenge of actually charging employees for the usage of the wallet. I think that would go counter to what we're trying to do. Remember, our brand promise is to make work life better. And I don't think charging those employees, especially those employees who can't afford to pay, usage of the wallet, I think that is actually ethically wrong. So the intent over here is to make sure that we design the wallet in the way that we can benefit from the interchange, at least in North America, that funds the wallet and allows us to make a nice profit through the use of the wallet.
Great. I really appreciate it. Thank you.
Thanks, Arvind. Our next question comes from Josh Riley, who's in for Scott Berg at Needham.
Hey there, guys. Thank you. So I was curious, what are you guys seeing with usage trends on the platform during the pandemic, now that you have several quarters of data points here? Are there any modules that might be surging in activity or upselling better than the pre-pandemic period? And then are you using any of that data in the sales process to cross-sell complementary modules?
So we've obviously seen a lift in terms of add-ons, as I've mentioned, in 2020. In 2019, we averaged about 20% of our monthly sales were add-ons to the base. That grew to 25% in 2020. And part of that was the global adds of the employee bases, but we obviously did see as well additional module add-ons. The type of add-ons that we typically saw were typically things around learning management, performance management, the compensation, the engagement surveys. If I look into 2021, we're very optimistic about what we're going to see in terms of the Hub and the Hub Plus that are coming out. I believe we'll continue to see benefits from the benefit intelligence that we released at the end of last year, which again focus on that quantifiable value and very, very strong ROI for the customers. So Josh, yeah, we did see obviously more usage across the modules as there was a general trend for more digitization across our customer base.
Okay, great. And then just one follow-up, international outside of Canada obviously has been growing as an opportunity here, given the M&A activity and investments in native payroll. How should we think about what regions you're going to be targeting for sales and marketing investments here in 2021? Obviously, we focused on APJ, but is there anything else that we should be aware of where there's a pretty meaningful opportunity here? Thanks.
Well, obviously, we're building out native pay for Germany at the moment. We've been quite successful in market with our workforce management product inside that particular region. And so you'll see us do a lot more investments in Germany and the surrounding countries.
Next question comes from the line of Yao Chu at Credit Suisse. Yao, please go ahead.
Hi there. Thanks for taking my question. David, I have one philosophical one for you on M&A. I can't imagine you're the only one hunting for these assets out there. Can you help us explain how Ceridian is differentiated or advantaged as a buyer versus either sponsors or local acquirers who may be looking at the same assets that you are?
Look, I think a lot of it comes down to what we can actually offer the employees of those particular customers. I think if you look at us compared to where they typically would land up, the companies were a lot more attractive option. Remember, if you look at the history of Ceridian today, it really started with the acquisition of Dayforce. And if you look at how we leverage the people from Dayforce, myself would be an example of that, in creating really significant career opportunities inside the Ceridian organization. And as Noemi mentioned, a large part of doing the Ascender acquisition was that we are now beginning to transition from that North American company operating globally to really a more of a regional model. And Ascender gives us really critical mass inside the APJ region, which again further differentiates us from the other players inside the actual market. On the global side, I do believe we have a significant opportunity to be differentiated in terms of our technology platform and how we can actually, if you like, leverage the people that we see inside country to win more and more customers.
Thank you. That's great. And if I may just have one quick follow-up on the pricing environment. Can you speak at a high level just how pricing has trended more broadly and the competitive dynamic? Are you seeing rationality in the marketplace? Do you expect pricing to recover from what you might call depressed second half COVID levels? How you just conceptually approach pricing and competition here?
I don't think that pricing really changed in 2020 as compared to 2019. What I would say, if it came down to more to contract terms, as us and others provided more flexible terms to our customers, starting in Q2 of last year, just given the inherent risk of COVID.
Thank you. That's very helpful.
Thanks, Yao. The next question comes from Kevin Kumar, who's in for Chris Merwin at Goldman Sachs.
Hi, thanks for taking my question. Question on PowerPay. How should we think about COVID and employment impacts to that business and the trajectory of growth? Should we think of it similar to Dayforce, seeing kind of a rebound in the back half of 21? Thanks.
I think that PowerPay is going to be under more pressure than Dayforce because it largely is, only is a small business in Canada. And if we look at Canada, the largest markets that we have, which would be Toronto and Montreal, are both under lockdown. So we are seeing more revenue pressure on PowerPay than we are seeing on Dayforce. To kind of quantify it, when we actually look towards Q1, the headwind, I believe, for PowerPay, Jeremy, is going to be what, about $3 million or so
That's
going
correct.
into,
Yeah, that's correct.
going into Q1. Whereas we look at Dayforce, which is a much more significant revenue stream, in aggregate, it's about 6.5 million. So it's obviously a PowerPay, it's still feeling COVID much more than we are seeing with Dayforce. And now I think the recovery is largely determined on the Canadians really getting their act together in terms of vaccine distribution. And currently it looks like the expectation is that they'll be able to provide vaccines to everyone who wants it by the end of Q3, which is somewhat in line with the US, although it's going to start probably a quarter later.
Great. Thanks a lot, David.
Thanks, Kevin. Next question comes from Brad Clark at BMO.
Thank you for taking my question. Just want to revisit cloud revenue retention rate ticked down a little bit compared to 2020. Just want to understand how much was employment impacting that metric versus other factors in the market. Thank you.
Sure. So the employment would actually impact really the net retention rate, which effectively remained constant around 106. So by the time you added the add-ons, less the employment numbers, you basically netted to the same amount. In terms of the actual retention rate, it came in at kind of 95.8 relative to 96.3 the year before, or 96 the year before that. So largely around 96% over the last 3 years. It was impacted by some of the small business losses that we saw on Dayforce that were linked to very small PowerPay customers that went out of business.
Thank you.
Next question comes from Matt Pfau at William Blair. Matt, please go ahead.
Hey guys, thanks for taking my question. Just wanted to ask on the international expansion strategy. So you kind of seem to be taking two different approaches, with Europe a bit more organic in terms of the build out, and Asia Pac a bit more driven by acquisition. So maybe just the rationale behind the different strategies there. And then also in terms of the partner program, any difference in terms of how you think about that between the two different regions?
Yeah, so Matthew, in reality, they're not that different. So if I look at UKI, we built out native payroll for first the UK, and then we extended into Ireland. And we've been very successful there, but we started with a little bit more momentum given the history that we had inside the country beforehand. In Australia, we started off by building native time and payroll for the ANZ market. We then did an acquisition of RITEQ, which largely was to get people who understood the workforce management side to allow us to continue doing implementations inside the region. Excelity and Ascend are slightly different because we were expanding our scope outside of ANZ into the broader APJ type of region. And particularly with Ascender, we're picking up a wonderful team of really experienced people in the ANZ marketplace that we do believe will further differentiate us, but also allow us to continue to grow inside that region. When we look more broadly on the global market, you'll continue to see that we're building out native pay for Germany. That doesn't mean that we won't look for similar types of assets around that particular type of region. We still have to start looking towards Latin America and other parts of Europe. The world's a big place, so there are lots and lots of opportunities out there. And I do believe that the